My name's Blake Hutchins. I'm co-manager with Hugo Ure, who's with me today, of the Troy Income and Growth Trust. Troy has been managing this trust for over 13 years, and we have always done so with a very simple aim: to deliver above average returns with below average volatility. And that is exactly what we're trying to do today and in the future. It's very clear what we represent. We're a UK trust that focuses on quality income growth. We invest in exceptional businesses, just the same as Sebastian, that are resilient and that can grow their dividends almost in any environment imaginable. Exceptional companies that have resilience and that are able to grow their dividends. And the good thing for me, fortunately, and frankly we wouldn't be doing this if this wasn't the case, is that the UK is home to various businesses that can do just this. At Troy, we invest from a clearly defined investment universe, a global investment universe of around 150 companies. And in the UK, we follow 70 plus companies that have these characteristics that I've just described. 35 of them are held across our UK strategies today, such as the Troy Income and Growth Trust. And you can see some of them on the left-hand side here. Companies such as Diageo, the world's leading international spirits company, owns the brands that many of us enjoy and admire: Johnnie Walker, Tanqueray, Baileys, and the like. Affords them great pricing power and affords them great resilience in times such as these. And then if I just highlight Croda, a newer addition to the trust. A couple of years ago, Croda is one of our leading specialty chemicals businesses in the UK. They actually produce ingredients that go into a range of products, such as beauty products, anti-aging cream, sun cream, not that we need it on a day like today, but they also produce ingredients that go into pharmaceuticals. If any of you have taken the Pfizer COVID shot, which I certainly have, it is Croda's stabilizers, their nanolipids, that are so important in the formulation of these incredible vaccines. And Croda has a very, very bright future in terms of future development of future drugs. So those are some of the 35 businesses that we own in the trust today. But we also follow a further 35 plus companies that we don't own today. And that gets to Sebastian's point. As valuations are coming our way, we're obviously dusting off our research, of which we have a rich bank of research on some of the companies such as those on the right-hand side. If I highlight the LSE Group, one of our largest companies here in the UK, owner of the FTSE indices, which we all know very well. Also owner of various data assets that many of us as financial professionals use on a day-to-day basis that are becoming more valuable to the way that we work. Or just Spirax-Sarco, we would argue the UK's leading engineering business, really well placed in today's world of energy efficiency and factories and customers really focusing on energy efficiency through their products and their solutions. They're absolutely paramount to their customers. So the bottom line is, what I'm trying to tell you here is that the UK is home and still is home to various world-class businesses. Now, the thing these businesses have in common, amongst other things, is their ability to produce recurring, resilient, growing cash flow. And that growth and that resilience of cash flow is the bedrock to resilient, growing dividends. We find companies in our investment universe that have low levels of cyclicality and low levels of capital intensity, because these are the companies that can endure and continue to generate that free cash flow and those dividends come what may. And in fact, if you look at the red side of this chart, that cross-section of intense capital intensity and intense cyclicality, these are the companies that we simply do not invest in. They just don't appear on our investment universe. Sebastian has already mentioned British Airways in this chart. We would also put Marks & Spencer in that, but also those industries that are incredibly cyclical, incredibly capital intensive, some of which are actually having their day in the sun right now because of high energy prices. Oil companies, banks, miners, you won't find those in the trust. Instead, what you will find are those consistent cash generators, consumer staples companies such as Unilever, which we've owned for over 13 years in the trust, or even those companies that exhibit some capital intensity but no cyclicality, or some cyclicality but no capital intensity, such as you can see in the middle. Intercontinental Hotel Group's a good example, a franchise business model. We all would have stayed in one of their hotels, I'm sure, but they don't own the physical hotels. And so that means whilst demand is variable, the capital they need to put down does not ruin the business. It does not impair investors' long-term capital. And that's what we're looking for in the trust. A great example of a company, and it's actually one of the largest companies in the trust today, that have these kind of cash flows that we value, that we look for, is RELX. RELX is arguably the UK's leading technology company. It is a data business. It has various technology assets, and it also owns exhibitions. And you can see in 2020, clearly, with the pandemic and all of us being locked up for however long we were, exhibitions just didn't happen. Trade shows didn't happen. Events like this didn't happen. And so there was a rare year where cash flow went backwards for RELX. But in general, you can see this business is incredibly resilient to recessions. And that growth in that free cash flow, which you can see in the bar charts, is very much upward trending. And also the free cash flow conversion. This is how much cash does a company generate for the level of profit that they generate. And we love to see cash conversion at very high levels. And you can see here not just high levels of free cash flow conversion for RELX, but you can also see the fact that it doesn't vary very much at all. So these are the kind of cash flows that really support the dividends and the income behind the Troy Income and Growth Trust. The contrast to that is a company such as this. And if you just eyeball this chart, the bar chart is, again, the free cash flow. The line is the free cash flow conversion over time. And frankly, it's random. It's unpredictable. It's highly volatile. And it is just not something that we can accept or build a strategy around for you and our shareholders. This is Anglo American, a mining company. You will note that in 2021, just how high and unusually high those free cash flows are. And it's little wonder that Anglo American has had good share price performance of late. But frankly, if we roll forward a year or two, it's anyone's guess what that number is, and it's any guess what their dividend is, quite frankly. These are just not the companies that we rely on to pay dividends to our investors. Instead, we focus on quality income growth. So where do we find those opportunities? If you just walk around the wagon wheel, you can see about 25% of the portfolio are in consumer staples companies. We've talked about a few of them already: Diageo, Unilever, Reckitt Benckiser, Nestlé, as per Sebastian's presentation. 10% of the trust is in healthcare, AstraZeneca, GlaxoSmithKline. 20% are in more technology and data assets, which we like. About 10% are in these specialty engineering chemicals companies such as Croda, 9% in asset-light consumer discretionary stocks like IHG, and then about 10%, 10 to 15% of the trust are in slightly more asset-intensive areas that are incredibly predictable. So companies such as National Grid or IMPP, Assura, PHP, they're the owners of the GP surgeries that we all go to across the UK. They basically get paid rent from the NHS. They have good inflation linkage at a time like this. They have pretty bulletproof cash flows and dividends. So taking a step back, a very distinctive portfolio that you will note looks absolutely nothing like the UK market. And for that, we make no apology, but I will come back to that point just shortly. The top 10 of the portfolio. The nice thing about it, particularly for the retail investor, is that these are names that you would recognize. It's a concentrated portfolio. Nearly 50% of the trust is in the top 10. And we are very much focused in the way that we construct portfolios at Troy. I've spoken about some of the names on this page, such as RELX, such as Diageo, but maybe I'll just touch on a couple of others. GSK, I'm sure many of you in the room are shareholders either directly or indirectly, and I hold out great hope that finally, after 20 years of trying to digest this monster acquisition that was made, and the big merger that formed GSK 20 years ago, you will know that in July of this year, there's finally going to be a separation of the consumer health business from the pharmaceutical business and the vaccines business. And as I said, I hold up pretty good hope from particularly attractive starting valuations that this will finally let Glaxo invest in the way it should. You will know that they cut their dividend this year in order to reset the business for the future, and that is definitely a top 10 holding for us. And as I said, I hold up good hope for better returns from Glaxo from here. And then finally, Compass Group. I mention it because it's very much synonymous with the kind of company that we like. Multinational businesses that are highly diversified, that actually have market-leading businesses in the US. And as a UK investor, I feel very lucky because of our international nature of our economy, of the history of the UK. We do have multinational businesses, and Compass could just as easily be listed in the US because that is where about 60 to 70% of their profits come from. But they are the world's biggest catering company. They buy more food in the US than anyone else in the whole market. And that gives them incredible economies of scale, and it means that they're able to win share from their competitors by undercutting them and delivering better service. So this is just a selection of the kind of companies that you find in the trust. I said earlier that our portfolio is incredibly differentiated from the index, and therefore it is incredibly differentiated from a lot of our income peers. That is a very important point to note. Now, over time, that has very much been to our advantage. You can see in blue the returns of the trust versus the index in red. But you will also note in the bar charts is that in any given year, our returns can differ very materially from those of the index, and as I say, therefore of our peers. In years such as 2014 and 2015, this was clearly much to our benefit. In difficult markets, the trust delivered a very positive return. But then in years like 2016 and 17, when the market rebounds strongly, we tend to leave some on the table. This year to date, as Sebastian said, the only game in town has been commodities. That hasn't helped us. We do not own a single commodity stock in the trust. But as we get into more difficult environment, as resilience and perhaps we get more pressure on earnings and cash flows for the consumer and companies, we think we can rely on the car companies much as we have in the past. So when I analyze a company, I'm always thinking about the interplay or the balance between the quality of the business, the future growth of that business, and the valuation that we are paying for that business. It's almost like a triangle, thinking about the interplay between the quality, the growth, and the valuation, or yield, as I've put it here. And I think we should do the same for portfolios, and that's what I've done here. If you aggregate the portfolio, you can see in terms of quality what one is getting. You're getting, on average, 20% operating margins, 20% return on invested capital, which incidentally is about double that of the UK market. And then in terms of growth, and this is where we must take this with a pinch of salt, this is forward consensus estimates, and I don't think it takes any of us to stretch our imagination to think that we're going into a more difficult environment. But the point is, it is very important that we embed future growth within the portfolio in order that future dividends grow as well. And what are we paying for that higher quality, that better durable growth? Well, we think we're paying reasonable valuations. A 5% earnings yield can obviously be inverted to create a PE of around 20 times earnings. And very importantly, that 5% earnings yield is supporting a dividend yield of around 3%. And I'll just dwell for a second on this point on dividend yields. In this uncertain environment where the capital return is uncertain, that tangible return we get from a dividend and investors get from a dividend is likely to be valued even higher than usual. And what I would say about our dividend yield, and you can see here at the portfolio level, is that it's comfortably covered by earnings. That 5 covering 3 is a very good sign in my book. Not only because it says that the dividend is sustainable, but it also is saying that our companies are, on average, retaining 40% of their earnings to reinvest. And why wouldn't they do that when they can reinvest at 20%? So 40% times 20% is 8%. I'm not saying we're going to deliver 8% every year, come what may, but on average, that's the kind of mentality that our companies are having. Retaining 40% of their earnings to reinvest at high returns is the fuel for future growth and future growth of the dividend. So that leads me just to highlight who the trust is likely to be for. Given, I hope, how clear I've been as to what we're trying to achieve, which is quality income growth in the UK market, you may be able to answer this question for yourself. Most likely it's for that person who's in or approaching retirement, who wants that reliable income stream, but doesn't want to see their capital erode, that wants to see their capital grow, perhaps to pass on to future generations. Or it could be someone like myself who doesn't need the income today, who uses that dividend to reinvest. And that's a particularly nice feature of an income fund in difficult markets like today, when we're all wondering when we should start to reallocate to equities. A dividend reinvestment mechanism is an incredibly powerful tool in this environment. 4 times a year, a quarter of the dividend yield from the trust will be reinvested back into the market, and that takes the decision away from us and is always a very good engine for long-term compounding. I'm sure you'll agree. So we think it's for those who want that attractive quality income stream, or that person who wants a resilient total return, or even someone who wants both. Finally, who is the trust not likely to be for? Well, we do not strive for high yield. We will not risk capital in order to strive for that highest yield. And we will not replicate the UK market. We think that's what passive funds are for. And you will note you can get a high yield from the UK market, but we don't like the composition of the UK market. And that option is always there for investors should they want it. And then finally, in typical Troy style, we're the opposite of targeting a fast buck. And so we would always encourage a long-term perspective. With that, I'll just leave you with the 3 key points from my presentation. The first is that we are a UK trust focused on quality income growth. We invest in resilient companies, many of which we have owned for over 13 years, or the 13 years we've been managing the trust, which is reassuring in these uncertain times. And then finally, a well-funded dividend supported by earnings growth that we expect to be able to grow into the medium term.